Feel free. All right. Thank you. So let me start sharing my slides. I'm trying to share my slides, but I'm having some, I don't know. It's giving me options. Right? Choose what to share with up. Right from this time. Is the IT guy with us? Is the IT guy with us? Who is recording? Is a classwork recording or is the IT guy?
Sir, the not
said,
the IT guy.
Please enable access to your. No. He said that you were talking. He said, the IT guy. What happened?
He's not with us, but there's someone from the school recording the meeting. Yes, they are responsible for recording.
Yeah, I'm trying to share my slides. Is the person with us? Is the person with us? I don't know what they have done. I'm trying to share my screen, my slides, but when you click share, it's giving me three options: Chrome tab, window, entire screen. Why? The entire screen talking about the Zoom, but I can't find the on my desktop. I can't find the. What is going on?
Sir, you are on the right path. The screen you want to share, if you share the entire screen, we'll see everything on your machine. If you share a window, we'll see what you are displaying on that particular window.
The entire screen, even also share, even the entire screen is not the share is not enabled.
So what of the window?
Window 2, the same thing. The share is not enabled. None of them is not enabled. It's a cancel. You only see share, cancel, and the share is not enabled too.
You see pictures of the things you want to, the window or the entire screen you want to share. You just select one of them and see.
Okay. You see,
Yeah.
this is what you see. You see, I hope you have seen what I'm sharing now. What I'm sharing is the screen, is the Zoom screen. That is what. But it's not supposed to be like that. When you click the share, it's supposed to give you all the things you have on your desktop, so you can share whatever you want to share from your desktop. So from your screen. Okay. What is the problem?
So, Doc, this particular one you selected.
Mm-hmm.
Can you select a different one?
Yeah, I'm trying to select a different one and see. The options I'm having. I can't find my PowerPoint. What I can find is my Zoom.
But have you opened your
Okay.
PowerPoint?
Yeah, I've opened it. Yes. Let me close some of the things I have on my desktop and see. God, this is strange. This, you know, choose what to share with app. What kind of app is that? What kind of app is that?
The Zoom app.
Okay. Let me try to log in again on camera. Let me log out and log in again. Let's see. Let me go to my accountant. Just 1 minute. Hold on. Okay. I believe you can all see the slides, right?
Yes, dog.
Okay. So the name of the course, Financial Analysis for Managers. And my name is Emmanuel Attakumah, as I told you. So this particular course, we're going to have an assessment. So there will be a combination of continuous assessment and end of semester examination. So the continuous assessment will consist of class, assignment, quizzes, and tests, and then so you'll be given an assignment, okay? And then you will not be doing mid-semester and those kind of things. You'll be doing only assignment, then you write end of semester examination or end of module examination. Okay, and then the weightings for the two modes of assessment shall be as follows. So continuous assessment is 40%, and then the end of semester examination 60%. And then this is the grading system for you. Okay, so if you score 80, between 80 to 100 is A. Then if you score between 75 to 79 is A minus. If you score between 70 to 74 is B plus. If you score between 65 to 69 B. If you score between 60 to 64 is B minus, and then 55 to 59 is C plus. And if you score 50 to 54 is C. 45 to 49 is C minus. Then 40 to 44 is D. If you score anything below, it's 39 below, sorry, it's F. Okay. And then in your result, when you see X is absent. So if you're unable to write your exams, okay, maybe you have you written your assignment, it may have your continuous assessment, but you don't have any semester score. Okay, the result will show X, it shows absent. Okay, and then we also have disqualified, that is Z. So this disqualified Z, if you see Z in your grade as well as your grade is disqualified, and it means so many things like examination or pattern, all those kind of things should be disqualified. Then when you see IC is incomplete. Okay, IC is incomplete result. It means that maybe you have your class score, don't have your exam score, or you have your exam score, don't have your class score. Okay, and that one can be fixed by the examiner. Okay, and then AD is audit. The learning outcome for this particular model. So on successful completion of this model, the students should be able to evaluate the performance of a company using various financial analysis tools, able to analyze different patterns of cost behavior and apply cost volume profit analysis to business decisions. Should be able to apply the discounted cash flow and other techniques to capital investment decisions. Then the last one is able to evaluate the performance of business units using both financial and non-financial measures. And these are the various topics we are going to deal with. That introduction to financial statements. That's the first topic. Okay. That's the first topic. So under that topic, the subtopics are understand the financial statement, that income statement, statement of financial position, the cash flow statement, a statement of shareholders' equity, and how they relate to each other. Analysis for decision making. Then the second topic is financial analysis tools. That is the tools we are going to use to analyze the financial statement. That is the trend analysis, common size analysis, ratio analysis, industry analysis. We're going to deal with them, okay, in details. Then the next topic is cost behavior. It's cost behavior. Under cost behavior, we're going to talk about direct and indirect cost, fixed, variable, and semi-variable cost, marginal costing, operational gearing, or leverage. Then we're also going to talk about cost volume profit analysis and business decisions. And we're going to talk about break-even analysis, assumptions and limitations, short-term versus long-term decisions. Then we also come to capital investment appraiser. Okay, and under it, we're going to talk about the appraisal tools we're going to use to appraise our investment. And these are the accounting rate of return, payback period, discounted cash flow techniques, net present value, that's NPV, internal rate of return, and profitability index. We are going to deal with them in details. Then we're going to also talk about divisional performance measurement. That is centralization and decentralization of businesses, cost center, profit center, and investment center, then financial and non-financial performance measures. And this is the book by Dyson JR 2017. This is the book. You go online, you can get it. You go to our library, you find these books there. Okay. So let's start. Introduction to financial statement and analysis. At the end of this lesson, students should be able to explain financial statements, explain accounting principles and concepts, interpret and analyze financial statements. So at the end of this topic, you're able to explain what they mean by financial statement, you're able to explain accounting principles and concepts, and you're able to interpret and analyze financial statements. So let's start. What is financial statement? Let's discuss. What is financial statement? Yes. When you hear about financial statement, what comes to your mind? What is financial statement?
Doc.
Yes.
Yes, it's a formal record that shows the financial performance and position of a business.
It's a formal record.
That shows the financial performance and position of a business.
Okay. Any other, please? Yes. That is, you mentioned your name first. What's your name? Ibrahim, right?
Yes, my name is Ibrahim Ature.
Ibrahim, okay. Yes, any other explanation of financial statement, please? Okay. So you're saying the financial statements are the starting point for financial analysis. So if you want to analyze financial, maybe if you want to analyze the financial statement, the first point is you have to look for the financial statement. That's what you're going to use to analyze. Okay. They provide information about income. So financial statement provide information about income, cash flows, assets, and liabilities. So as Ibrahim said, the financial statement shows the performance of the business. When we say financial statements, it's ambiguous. Financial statement is broad. So financial statement may be, is it an income statement? Is it a cash flow statement, right? So to effectively analyze financial statement, the analyst must understand the information provided by these financial statements, the shortcomings they present. So before you can analyze financial statement, you need to understand the information in the financial statement so that you can analyze it. Now, what constitutes financial statement? So financial statements normally shown in the annual corporate report include the following. So we know the annual corporate report, like at the end of the year during AGM, that's annual general meeting, the finance officer or the accounts officer prepare the financial statement and present it to Board of Governance for approval to show the business's profit, the business activities, and to also show to the company that, to show to the stakeholders whether the business is making profit or not, or doing well or not, and the asset and liability of the businesses. So the financial statement include statement of comprehensive income. That's the income statement. In other words, we can call it the profit and loss account. Sometimes you not see the income statement, you see it as written as P&L account. It means the same thing. Then statement of financial position. That is what mean by that's what mean by the income statement. So that's what mean by the balance sheet. So you can say the balance sheet or statement of financial position. You can say the balance sheet or statement of financial position. You can say the income statement or profit and loss account. It's the same thing. Then it also includes statement of cash flow. So statement of cash flow will explain how cash flows or cash inflows and cash outflows of the business. All payments made and all cash received are being recorded under the statement of cash flow. You have value-added statement, historical summaries, note to the financial statement. Okay. We're going to take them one by one. So financial statement, according to International Accounting Standard 1, revised, normally shown in the annual corporate report, include the following. Okay. So IAS 1, that is the standard that spell out the financial statement. Enough. Explain that statement of comprehensive income or P&L account, the balance sheet or statement of financial position, statement of cash flow, statement of changes in equity, notes to financial statement. Okay. Now we are starting with the balance sheet or statement of financial position. The balance sheet. Now, when we talk about the balance sheet, what comes to mind? We're taking it one by one. We're starting with the balance sheet, or you can say statement of financial position. When you say the balance sheet, what comes in? What balance sheet or what are the things you should look for in the balance sheet? The balance sheet.
Current assets.
You are looking at the assets.
Liabilities.
Liabilities. So assets, liabilities. Okay.
Then equity.
And then equity. Okay. Good. So the balance sheet represents the asset owned by the company and the claims against those assets. So the balance sheet represents the asset owned by the company and the claims against those assets. So based on accounting equation or the accounting identity, asset is equal to liabilities plus owner's equity. Asset is equal to liabilities plus owner's equity. So the balance sheet shows these three information, three items. That's the asset. So all the company's assets are recorded in the balance sheet. And then all the company's liabilities are also recorded in the balance sheet. And all the company's owner's equity are also recorded in the balance sheet. So these are the three informations you find from the balance sheet. What is asset? Now, what is asset? What is asset? What is asset? Yes. What is asset? Please feel free. Or what are assets? Yes.
Assets are
Who is speaking? Who is speaking?
Ibrahim.
Ibrahim, yeah, please let another person speak. Okay.
Okay, all right.
Let me hear from yeah.
Hello, sir.
Yes.
My name is Emmanuel Gazy.
Okay.
So I think assets are the short and long term of what the business owns.
The short and long terms of what the business owns. Okay. Okay. Any other?
Hello, sir.
Yes, your
Good
name.
morning. Gloria.
Okay.
So assets are resources that are owned by the company, which are used to generate profits for the company.
Okay. You're all right. Any other?
No,
Yes.
this is Emmanuel answer. Can we say
Okay.
the asset are things that have value? Like they have value and can be used for monetary gain.
Okay. Okay. Ibrahima, do you have
Yes.
other explanation? Yes.
Yes, I think they have already given the
Okay.
correct answer. Yes.
Okay. 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 So all what you have said are correct. Okay. In simple terms, asset are simply the properties of the business. The properties of the business. Okay. So the resources owned by the business are the properties of the business. What about liabilities? What are liabilities? What are liabilities? What are liabilities? Yes.
So can you say like debts?
Okay. They are debt. So liabilities are simply debt. They are debt or the obligations of the business. Okay. What about owner's equity? When you say owner's equity, what comes to your mind? Owner's equity.
Hello, Doc.
Yes.
Please, can we say shareholders' capital?
Is what is left for the business after you subtract any other thing that the company owes.
Is it the same person or two different people are speaking?
That is Oscar.
Oscar, huh? Come again.
It's anything. Hello?
Yes.
The network is bad.
Yeah, no, we can hear you. Please go ahead. Oscar.
Yeah, it is what is left for the owners of the company after you subtract all the things the company owes.
Okay. Then Emmanuel, you also said something. Can we come again?
Yeah, Doc. Please, I said it's also shareholders' interest on capital.
Okay. Shareholders' interest on capital, or I'm not getting it. Is it interest? I talk about interest on capital.
Yeah, yes, Doc.
What the interest, please? I'm not getting. Is it the interest the person is going to receive on capital, or what are you talking about?
Doc, I think he wanted to say maybe shareholders stake in the company.
Okay. Okay. Thank you. Okay. So and then the other person who spoke, the first person, you said you said something, right? Can you come again? Before Emmanuel talk, somebody said something. Oscar.
It's a dog.
You said something.
I said it is what is left for the owners of the company after we subtract everything the company owes.
Okay, so what's the name given to that?
That's equity.
No, that's not equity. I
That
don't
one
think
is
that's
dividend.
equity. What's it left?
That's
You
the
said
capital.
what is left after
We
deducting
subtract
everything?
everything the company owes.
I think it should be the profit or loss.
No, what you are saying is the profit.
It's the profit.
But the profit is not part of owner's equity. The owner's equity is within the profit.
So this is Bismarck.
Okay, Bismarck.
Yes, the owner's equity is the same as the capital, the owner's capital.
Owner's capital. Okay. So Oscar, let me explain what you said. Okay. So what is left? So what is left after deducting? That is after deducting all expenses is the profit, and the profit left. Okay, you can't tell me that's owner's equity. Okay, the shareholders will meet and then decide how they want to use the profit left. Well, how they want to use what the amount left, which is called the profit. Okay, so within the profit, they may decide that okay, let's use 50% or 60% to pay dividends of the profit, and let's retain the remaining. So the remaining you are retaining is called
Retain
retained earnings, and that is the owner's. That is form part of the owner's equity. Okay. Yeah. Because we're going to use for reinvestment. Okay. All right. Let's continue. So as I said, we are starting with the balance sheet. So the balance sheet. So these are the informations you find in the balance sheet. As I said, in the balance sheet, we say we have assets, liabilities, and owner's equity. Starting with assets. We say assets are simply the properties of the business. And let's mention some of the properties of the business. What are they? We have buildings, we have land, we have the motor vehicles, we have continue. Yes.
Premises.
The premises, yes, that's the land. Okay.
Equipment.
The building,
Not
that's
the
the
machine.
building, sorry. Equipment, okay. We have the patents, we have the
Plant and equipment.
trademarks, right? All of them. Okay. So asset can be
Long-term investments.
yeah. We have investment. Yeah, investment. They're part of the asset. Your investment. Okay. So asset can be categorized into two. We can group asset into current asset and non-current asset. We can call non-current asset as fixed asset.
It's okay.
Okay. What is a current asset? A current asset. What's a current asset? What is a current asset? Yes. What is a current asset? So we are saying assets are simply the property of the business. And this asset can be grouped into two. We can group them into current asset and non-current asset. What is a current asset? Yes. What is a current asset?
Hello, Doc.
Yes, Emmanuel.
Yes, please. So I think current assets are short-term assets that has a value within one financial year.
Okay, you are right. Any other explanation?
I think these are resources that can easily be converted into cash in the short run.
In the short run. Okay, in the short run. In the short run. So in the short run, I'll prefer you replace it with within one accounting year. Okay.
Okay.
To make it more specific. Okay, that's good. You are all right. And what is the example? So we are saying that all the properties of the business that can be converted to cash within one accounting year. When you say conversion means if you want to sell it, you want to change the asset to cash, you want to sell it so I can receive cash. It will take you within a year, not more than a year. So all those assets, we classify them as what? Current asset, right? Okay. So what are some of the examples of current asset? Yes.
Cash.
Cash. Cash at hand.
Inventory.
Cash
Bank.
at hand or cash in your bank, right?
Inventory.
What is inventory? When you say inventory, what does it mean?
Inventory is stock.
Goods.
Stock.
Yeah, goods that are yet to be sold.
Okay, goods that are yet to be sold. That inventory or stock. Okay, you are right. Okay. You remember, we have stock. Stock comes under current asset. But as soon as you mention capital stock is not. It means you're talking about shares, right? It comes under equity. All right. Okay. Okay. Owner's equity. Sorry. Okay. So we say inventory, cash at hand, cash having your bank balance. Yes. Any other examples of current assets?
Out of
Hello.
short-term investment.
Debtors.
Out of short-term investment.
Okay. Prepaid expenses.
Receivables.
Receivables. Okay. All right. Thank you very much. Now, so the other side or the opposite side will be the non-current asset or the fixed asset. So what is a fixed asset? What is a fixed asset or what is non-current asset?
They are assets you cannot easily turn liquid.
You cannot easily turn liquid.
Like for cash.
For cash.
Yeah.
I think somebody should help our sister small. Veronica. Somebody should help Veronica.
Hello, Doc.
Yes.
So I also think that it's the long-term assets that has a value more than one financial year.
Okay. So the long-term asset that have value more than one financial year. So you are going into more accounting. Some of us are not. Some of us have never done accounting before. So calm down small. Let's hear from others. Yes. So I want someone to polish what Veronica said. Veronica said they are the assets that cannot be easily converted to cash. I want someone to.
Okay, Doc, can we
Yes.
also say that they are assets that generate long-term value for the company?
Okay, long-term value. Okay. So all what I was trying to let you say is that at least the assets that cannot be converted into cash within one accounting year. And I've already explained that the conversion means if you want to sell it, the asset to receive cash, right? So if you want to sell the asset, it will take you more than a year. Okay. So all those assets are classified under non-current asset or they are fixed asset. Example. What are some examples of non-current asset?
Of land.
Land.
Machines.
Machines.
Buildings.
Land.
Long-term investment.
Long-term investment. While short-term investment comes under current assets. Okay. All right.
Furniture and fittings.
Okay. Thank you very much. So So we have this. Okay. Now we've got the concept. So we are saying that non-current assets are assets acquired to be used by the firm for more than one financial year. This consists of both tangible and intangible assets. What is a tangible asset? What is a tangible asset?
Assets that can be seen or felt, or you can feel it and see.
Good. Example.
Buildings.
Building. So we can see building, we can touch building. So it's a tangible asset. Okay. What is intangible asset? Or what are?
Cannot be filled or touched.
Example.
Patent rights.
Okay. License, patent rights. Okay, good. All right. Okay. And then the current assets are that acquired to be consumed within one financial year. They include stock, debtor, short-term investment, and cash in the rest, as we said. Okay. Now let's come to liabilities. We all know that liabilities are what? Are debts or the obligation of the business, right? Okay. We can also classify liabilities under current liabilities and non-current liabilities. Okay. So the current liabilities are simply the short-term debt. You can call current liabilities as short-term debt, and then non-current liabilities are long-term debt. Okay. So what are okay? How will you explain current liabilities to someone? What is a current liability? What's a current liability? Yes.
Doc, they
Yes.
are obligations.
Isaac.
Yes, Doc. Good morning. They are
Morning.
obligations which fall due within one financial year.
The obligations which fall within one financial year. Any other explanation, please? Okay. Or in simple terms, they are debt payable. They are debt payable within one accounting year, or one financial year. They are debt payable. So all the debt the company can pay within a year, from January to December, within the year, you classify them under what? Current liabilities. Example. Current liabilities. Example.
Salaries.
Okay.
Salaries.
Yeah, one after the other. So come again, please.
Salaries.
Okay, Oscar. Salaries.
Accrued debt.
Accrued debt.
Short-term loans.
What is accrued debt? Yeah, somebody may ask, because some of us have not done accounting before. What's accrued debt? Because we don't want to come across this in our next lecture, and then people ask the question, what's accrued debt? Or what are accrued debts?
These are debts like accrue this month, which are due next month, the following month.
Please come again.
These are debts which have been accrued this month and are due next month.
Next month. Okay. All right. Okay. Now let's come to the non-current liabilities. Okay, we know that non-current liabilities, if current liabilities are debts payable within one accounting year, non-current liabilities are also debts payable within one accounting year. So it takes more than a year to pay for the debt. Okay. Example of non-current liabilities are
long-term loans.
Long-term loans.
Bonds.
Credit.
Okay. Thank you. So this is an example of the balance sheet. So this is an example of the balance sheet that the Vista product balance sheet as at 31st December 2017 and December 31st 2016. Okay, dollars in millions. So you have the assets, the current assets, cash and equivalent, short-term investment, account receivable, inventories, and other current assets. You add them to get the total current asset. Then come to the non-current assets. We have net plans, property and equipment, other long-term assets. So when you add your current assets to your non-current asset, you get total asset. That for 2017 is $21,091. Okay. Now let's come to the liability side, or that the right side, the balance sheet. We have the current liabilities, account payable, short-term debt, other current liabilities. When you add all of them, you get the total current liabilities. Then come to the long-term debt, other long-term liabilities. So when you add your current liability and non-current liability, you get total liabilities, and that is $10,483. Then you come to owner's equity. Under owner's equity, we have
Common stocks.
common stocks, we have retained earnings. So when you add your common stock to the retained earnings, you get the total owner's equity to $10,608. So when you add our liabilities to our owner's equity, we are getting $21,091. Okay, and then total assets for 2017 we got $21,091. Now you see it has balance. So in the case whereby one side is larger or smaller than other side, it means there's something wrong. It should be the same. That's what we call the balance sheet. It means that balance. Okay. This is an example of the balance sheet. Okay. At this stage, nobody's going to have to prepare the balance sheet, please. Okay. This is also an example of the balance sheet. Okay. We have the 2016, we have the non-current asset plan, property, plant and equipment, goodwill. What is a goodwill? What is a goodwill? Yes. You are saying goodwill is an asset. What's a goodwill?
Is it right?
You said?
I said, is it right? Can it be said as right? Good.
Okay, you are telling the class, so you are not telling me. You're telling the entire class.
I think it happens when there are takeovers.
When they are
Takeovers.
we can't hear you well.
Hello.
Doc, I think they are intangible assets.
Yeah, they are
Goodwill.
intangible assets. Okay.
Yes.
So what is a goodwill? What is a goodwill?
Goodwill, it relates to the company's reputation.
Okay. Yes. I like that. For example, you are driving, okay, and then you short of fuel, and then you see a gas station named ABC gas station. This ABC gas station, you've never heard it before. You will not risk your car to go and buy the fuel because you don't know the ABC. It doesn't have any reputation. It doesn't have any good name. But when you're driving, you come across maybe Shell, Toyota, Goil, you have confidence to buy it because you trust that company. You have no fear, no worries because it has a good name. They sell good product. Okay. Yeah. You see the problem in Ghana, we have buying cars from Kantaka company because of goodwill. Somebody may prefer to buy a car from Toyota, Benz, BM than go to Kantaka because of goodwill, the reputation. So they don't have future issues. Okay. So goodwill is an asset. It's an asset. Okay. And it's a non-current asset. And it's intangible asset. All right. Thank you. So under the current asset, we have inventory, trade receivable, bank.
I have a question.
Yes, please.
So how do we value goodwill? How can you value it and give a figure to it?
Oh, to value goodwill. The company goodwill, is it how can you value it?
Yes.
Somebody's asking the whole class, so.
Sir, can I say something? This is Sandra.
Yes, please. Yes, Sandra.
I think the goodwill can also be loyal customers. So probably you know that there's some customers every month, you know that their cash flow is assured, they will buy. So I think that's why in this balance sheet, there's an amount allocated to it.
Okay. Any other explanation, please?
All right. So I think that when the net assets, so the consideration paid exceeds the net asset of the company, that is when goodwill is recognized in the financial statement. It more or less happens in takeovers when your net asset is 10,000, but then the consideration you're going to pay is 12,000. Then the difference, that 2,000 is recognized as of goodwill.
Please come again so that they can hear you well. They can get you well, sir. Who is speaking? Is it Oscar?
No, please, I'm the one who asked the question.
No, the one who just spoke.
My name is Sen.
Sen, okay, come again so that they can hear you well. They can get you well so they can understand what you're saying.
What I'm saying is we recognize goodwill when the consideration that is paid exceeds the net asset of the company. So assuming the net asset is 10,000 and the consideration in terms of takeover is 12,000, that 2,000 difference is recognized as goodwill because of maybe the name of the company and so forth. Yeah.
Okay, so Sandra asked the question, right?
Oscar did.
Oscar, huh? So are you okay?
I didn't hear the explanation, but let's continue. I'll get it later.
Oh, you didn't hear? Okay. Okay, please come again with the explanation. I think it was clear. Okay. Okay. All right. And then we had the equity and liabilities. Equity shares at 50 pesos. Okay. Then retained earnings. Then non-current liability, we have 8% loan notes. Current liability, we have bank overdraft, trade payables, current tax. Okay. This is an example of the balance sheet. Okay. So we've talked about the balance sheet. Okay. And then the owner's equity are the stock, the preference, the stock that is talk about the shares, and then the retained earnings. Okay. Preference shares they are not owner's equity, they are investors. That is why we don't consider preference shares as part of owner's equity. Okay. So preference shares, they are normally considered as investors. Okay. So under the owner's equity, we look at the two, the retained earnings, and I've already explained the retained earnings. Okay. Retained earnings to you. Okay. That after deducting all your expenses, what is left is your profit, right? And then and the profit left, the shareholders or the owners of the business will decide that okay, let's use about, let me say, 50% or 46 or 60% to pay for dividends, and then the remaining should be used for reinvestment. So the remainder used for the reinvestment are called the retained earnings. Okay. The income statement too. So the income statement is one of the company's core financial statements that shows their profit and loss over a period of time. So if you want to find out about the business, whether the business is making profit or loss, you have to go and look for the income statement. If you want to find out about the company's assets, you look for the balance sheet. If you want to find out about the company's liabilities, you look for the what? Sorry, you want to find out about the company's assets, you go and look for the balance sheet. If you want to find out about the company's liabilities, you look for the balance sheet. If you want to find out about the company's owner's equity, you have to search those information from the balance sheet. But if you want to find out about the business, whether the business is making profit or loss, you go to the income statement or the profit and loss account. Okay. So the income statement reports revenues generated by the sales of goods and services from the firm's continuing operations. We know that every business exists to make what? Money or profits, to generate what? Revenue, right? Generating revenues are in two forms. Either you sell a product to receive money or you render a service to receive money, right? Like those in the hotel management, like the restaurants, they render services and they receive money. And those who produce, those in the manufacturing companies, manufacture something, a product, you sell them and then receive revenue. Okay. So the cost of manufacturing or purchasing the goods sold are deducted to arrive at the gross profit. We all know our business mass. Okay. That's, for example, you want to produce something. If you want to produce something, you look for the cost of the raw materials, the cost of labor, and the cost of overheads. That is your indirect cost, like your electricity bill, the water bill, and other things. You have to deduct all before you arrive at your profit. Okay. Let me go straight. Okay. Now, so revenue. What is revenue? So collect all income generated from sales of goods or services, including any other income sources. So our revenues is generated from sales of goods or when you render service. That's where we get our revenue. Then we have a term called cost of goods sold. Cost of goods sold. This includes the direct cost associated with producing the goods sold, like the raw materials, direct labor, manufacturing overhead. All this comes under cost of goods sold. Okay. Then operating expenses. These are the regular expenses incurred in running the business, such as rent, salaries, utilities, marketing costs. So let's take an example that we are working in, let me say, a cement company, right? So for us to get money to run the business, we need to sell cement. We need to manufacture cement and sell so that we can get money. Okay. Now, so any cement we produce or manufacture, we sell. That's where we get our revenue. Now, before we can sell this cement, we have to manufacture cement. And this cement, if you want to manufacture, you have to look for the raw materials for manufacturing the cement. So the cost, you have to buy raw materials. That's the cost of raw materials. You have to consider the cost. Then we have to employ workers. That will call the direct labor. So the workers may be permanent staff or maybe part-timers. Then manufacturing overheads. We have to also look for the manufacturing overhead. You see, like the machine that will convert the raw material to finished goods. Okay, the cost involved. All right. All this comes under the cost of goods sold. Now, after we have incurred all this cost to produce the cement, we still incur other costs like the building we are living, or we are doing our business. Maybe we are renting it, right? We pay salaries. We're going to pay staff salaries, the director, the MD, the general manager, the marketing manager. We pay utilities like light bill, water bill. Then we're going to market. Maybe we're going to advertise the product. Like you go to the media, you do advertisement and other platforms where you advertise. All the costs incurred. All this comes under the operating expenses. Then interest cost include any interest paid on loan. Maybe you went for a loan. Okay, you have to deduct your interest. So that the interest paid on the loans. Then tax expenses. Okay, the income tax and other relevant taxes you have to also pay. Okay, before you arrive at your gross your profit. Okay, so the first step is revenue less cost of goods sold to get your gross profit. Then, if you have any other additional income, you add, okay, operating income to get your earning before interest and tax. Then you less your interest, you less your tax, then you get your net income. There is a format we follow. Okay, so this is the format. So revenue, less cost of goods, and then less the cost of goods, you're talking about raw materials, direct labor, manufacturing overhead to get a gross profit. Then you less your operating expenses, you less your salaries, you less your rent, utilities, market. This comes under operating expenses. Okay. Then you arrive at the operating income. Then less your interest expense to get your earning before tax. Then less your tax to get your net income. Okay. This is an example of the income statement. This is an example of the income statement. So revenue, less cost of goods sold, depreciation, selling, and general. Okay. This is an example of the income statement. All these are some of the examples of the income statement. You are not going to prepare the income sheet, but I need to know how the income statement or what goes into the income statement. Please, if there's any question, I'll stop here. I'll pause here. Then today is just I'm not going much details because I'm not running fast, so that we take it slowly. Then I can share the slides with you, whatever questions you ask. So I'll pause here for questions, and then I'll share the slides with you. We meet, and then we go into details. Yes, please. The floor is open, please. We have done the balance sheet. We have done the income statement, and I've shown to you the format on examples of the income statement and the balance sheet as well. You are going to prepare the income statement. That when we come to when you're going to do the marginal absorption costing techniques, that we use we're going to apply this format. But for now, just get the intro first, this concept first, so that we can build upon and then move on. Okay. Okay. If there's no question, because I don't want to be moving faster and then some will be left behind, because some of you haven't done accounting before. This is the first time. Okay. So I'm taking it slowly, but when we get to the time where I have to speed up, I'll speed up. So I'll share the slides with you. Go over. Take your time to go over. We meet. I think we are meeting next week, and then I'll just recap or just go over whatever we have done, then continue from there. So that if you have any doubts or you don't understand anything, I can be able to explain to you to get a concept. Then we can move on. Because we are taking it slowly. So I'll share it with the class rep. What's the name of the class rep? Is it Joyce?
Yes, it's Joyce.
Okay.
Well.
Joyce, are you there?
Joyce
Hello.
and Sam.
Is it Joyce?
Papa Sam.
Is she with us? Is she with us or she's not with us?
She was here. I think probably her network.
Please, we have 2 reps here.
Okay.
Hello,
So
sir.
Jason and
Yeah,
who?
she's back.
And who else?
Papa Sam.
Hello, sir.
Yeah,
Sir
Joyce.
Joyce is back. Yeah.
Okay. So Joyce, I'm going to share the slides
Hello.
with you. Joyce,
Yes,
I'm
sir.
going to
Yes,
I'm
sir.
going to
I
share
can hear you now.
I'm going to share the slides with you right now. You share with them, okay?
Okay, sir.
So that they can take
Okay,
their
sir.
time to go through, and then we can meet. So that because they need to, you see, this is the foundation. If you don't get the concept of this foundation, it's very difficult to understand as we proceed. So that's why I'm going slowly. All right. Thank you very much for your time. And then, it's online. That is why I'm sharing the slides with you to also go through. It's part of the lecture. Okay. Yeah, I don't want to be moving fast because at the end, if I finish and you don't get the concept, I haven't done anything. Okay, I'm supposed to achieve my goal. That is for you to understand the concept to be able to apply. Okay. All right. Have a nice weekend and a happy Sunday. And I would like to take this opportunity to wish all mothers a happy Mother's Day. A happy Mother's Day.
Thank you, dog. Thank you.
Thank you, sir.
Thank you.
So the guys, please show them love. Show your wives love.
Happy
Your wives
Mother's
and your
Day to all
girlfriends, show
ladies
them
here.
love.
They are not romantic at all.
Be romantic.
But we are wishing you Happy Mother's Day now.
Yeah, tell them, give it to them. Give it to them.
Yes. Show romantic so that they can give you a romantic I don't want to mention
Treat.
it. Treat. Yes.
It's your bano. You're not so dear man.
Hey.
Easy.
All right. We meet next week. Have a nice day. Bye-bye.
Bye.
Okay, bye.
Gazy, and I will call. Emmanuel Gazy.
Sandra.
Then I'm here.
Naya Poana.
Yapo.
Sorry.
Gazy, only Gilbert. Gilbert.
Remember catfish. Remember Rick.
Master in upon 9.
Sandra.
Yes, Gilbert.
Iris, remember catfish.
Hey. You remember catfish time then?
I'm not vibrating fast.
Now Chrome Hana said, Ube ni wo Chrome Hana said, "Oh, Kumasi."
Mefaka ati nimre na maba ni akọ catfish.
Yo mate. Mefra wa mawa do say yes.
Hey, Daniel Yabwa.
Hey, Yima Dani woy.
Oh, silent killer.
Lima, right?
Minyere.
What's that kind? What catfish?
You
Now who quite sorry?
Maybe Yapon. Sorry, Yapon.